Buenos días a todos. Mi nombre es Miguel Ángel Aranda. Vamos a esperar 2 o 3 minutos para que las personas que asistan a este webinar se vayan conectando y en 3 minutos empezamos la sesión. Bueno, vamos a empezar. Buenos días a todos. Mi nombre es Miguel Ángel Aranda, soy el director de Madrid de Asset, la Asociación Española de Financieros de Empresa, y lo primero de todo, pues espero que todos estéis bien y que esta situación de la crisis sanitaria producida por el COVID-19 pues que os haya afectado lo menos posible o no os haya afectado de cerca a ninguno de vosotros. Quería daros la bienvenida en nombre de Asset a esta nueva webinar que hemos organizado bajo nuestro objetivo constante de intentar trasladar conocimiento y las mejores prácticas en todas las áreas relacionadas con las finanzas de la empresa. Hoy tenemos un webinar especialmente interesante de la mano de Refinitiv y de Reuters, en el que nos van a presentar una visión general de cómo las economías mundiales, los gobiernos y los mercados están afrontando esta crisis provocada por el COVID-19. Os animo a escucharla hasta el final. También, si queréis, podéis hacer preguntas a través del chat del webinar y os animo a escucharla porque nos puede dar una visión general muy interesante para todos los que estamos trabajando hoy en las finanzas de la empresa. La presentación se va a desarrollar en inglés, tanto la presentación de Mike como Daniel será en inglés, lo digo pues bueno, pues para que estéis preparados. No robo ni un solo minuto más de tiempo. Ahora le voy a ceder la palabra a Bruno Gerlich de Refinitiv. Tan solo daros las gracias a todos por asistir a este nuevo webinar de Asset, y en el caso de que queráis ver los próximos webinars que vamos a tener, pues os invito a entrar en la página web de www.asset.es, donde podéis verlo todo. Bruno, te cedo la palabra. Muchas gracias.
Sí, muchas gracias, Miguel Ángel, y buenos días a todos. Estoy agradecido en nombre de Refinitiv de ver que somos más de 500 profesionales de España reunidos hoy en este webinar sobre coronavirus y mercados financieros. Y agradezco la fantástica gestión de Asset. Como sabéis, Refinitiv no es más que el nuevo nombre de la otra edición Financial and Risk de Thomson Reuters. Y últimamente los 3.000 periodistas de la agencia Reuters, junto con los 2.000 analistas de Refinitiv, alimentan a marcha forzada nuestros servicios de contenidos por el rápido desarrollo de la pandemia y de sus efectos colaterales en las esferas sanitarias, políticas, económicas y financieras. Estamos en camino de desembocar en la peor recesión mundial desde la Gran Depresión de 1929, con un desplome sin precedentes de los mercados en este último siglo. Los mercados de valores se han contraído en un 30% entre el 20 de febrero y, si no recuerdo mal, el 20 de marzo, en solo un mes. Es impresionante. El 20 de abril el barril de crudo americano cerraba por primera vez su sesión en negativo a menos $37. ¿Y qué decir de las rentabilidades del Tesoro americano, que están en los niveles más bajos de su historia? Bien, pues con este panorama sin precedentes hemos querido reunir hoy a dos editores jefes de Reuters para que compartan con la comunidad financiera española su visión de la pandemia desde el prisma de la economía y sobre todo de los mercados. Empezaremos por Mike Dolan, editor jefe de Reuters para mercados, basado en Londres, y comentará los impactos de la pandemia en los mercados de capitales, divisas, tipos, deuda, y también el impacto en las estrategias de inversión y trading que ello supone. Le seguirá Dan Burns, desde Washington, para comentar las implicaciones de COVID-19 sobre las elecciones americanas. Y como dijo Miguel Ángel, por favor, aprovechar esos momentos de presentación para preparar vuestras preguntas. Antes de cerrar la palabra, de ceder la palabra, lo que sí quisiera es hacer hincapié en que vais a ver muchas pantallas que proceden de nuestros servicios de contenidos, Icon. A nuestros usuarios les recuerdo que, a pesar de que ya no estamos todos trabajando desde la oficina, tienen a disposición a su formador para identificar y organizar estos contenidos, y a los que todavía no los utilizan, por supuesto, me podéis contactar por privado o por correo electrónico para activar una sesión online. Por mi parte, no hay más. Introducir a Mike. Mike, this is all yours.
Buenos dias. Good morning, everyone. Good morning from London, thankfully sunny London. So listen, thank you to Refinitiv for the invite to give this presentation, and thank you for joining the webinar. Myself and Dan, who will speak later, are editors at Reuters, as Bruno outlined. So just wanted to stress at the outside, hopefully we'll be able to give you some insight into what we've been reporting on and what we've been hearing, and how that looks for financial markets in particular. We're not forecasters, and we don't have any positions on financial markets. I want to stress that at the outside. We're journalists first and foremost. But look, wow, what a year we've had so far. When I first discussed this with Bruno as a event, we were looking at the different things that might affect markets through 2020. And I think it's fair to say now there is just one major event in front of us, and this is what we'll run through today, hopefully to give you a helicopter view, and helicopter is an often used word at the moment, of what this looks like for business and finance, and particularly the world economy. I want to also just stress at the outset that I'm using essentially icon charts or Refinitiv data stream, but there will be other charts in there that I'll make clear we've taken from others or borrowed from different sources that we are covering from day to day. So There's a huge amount of information. It's been an incredible year. The hardest thing covering this topic of this pandemic and its impact on the economy and markets is just so much information and so little time. Let me try to give you a picture as we can see it. I mean, the first question that everyone had as this hit, and it really only hit financial markets in full force in late February, was whether this was as bad as big as shock as the great financial crisis of 12 years ago. You can see from the graphic that we just start off with, is trying to put this in some historical perspective of the market shock from the panic, and we have to remember that when this initially spread through China in late January, early February, the markets were very, very quick to shrug it off as if it were a one-off event that would be contained in China. And it wasn't really until the pandemic was outside of China and it was clear that it spread around the world that people realized that this was going to be a shock to the world economy across the board, and that the measures taken to contain the virus, certainly the lockdowns that we've seen across the world, would be a shock to the economy. And when the markets moved on that, in just 21 days, we saw one of the biggest drawdowns in history. It compares certainly with 12 years ago, although I think, as we'll talk about later, the way in which people are beginning to see this event is much more like a natural catastrophe than an organic recession as we've been used to in previous events that you can see here historically. Interestingly, the drawdown in world stock indices, and there's different measures and depending on which country you might look at, but if you take the MSCI all country index, which we have here, it actually, the first quarter was not as steep as the final quarter of 2008. And even though the peak to trough drop was as steep, the quarter ended up being slightly less. It's also interesting that we've had such a dramatic bounce back subsequently. But just to take you through the kind of where we are, everybody, both at home and in their professional lives, are looked at and are looking at the spread of this deadly virus. And I think there are many ways to conceive it. Here's the Johns Hopkins University site. I think most people will have their own favorite sites to try and get a grasp of the spread of this virus, but here's a good one that crams a lot of information into one page. You can see that the caseload, the new cases of the virus worldwide, is beginning to top out. It's by no means past. It's by no means contracting, but it's certainly past the peak, as many people would see, and certainly in many countries, with in Europe, where we're all seeing, thankfully, some easing of caseloads and fatalities, and in the last week, certainly an easing of the lockdowns that have been brought in to contain it. Here's a measure of just it's a stringency of lockdown or reactions. This is compiled by Oxford University, and this data shows just picking 6 countries here, that shows how severe relatively the economic shutdowns and economic stops were. This is social distancing, the closure of businesses, and the stay-at-home requirements. Again, these have all reached their peak at the end of April in Europe. As we see in China and South Korea, they're already been unwound. And as we can see in Italy and in Spain, and soon, I think over the next couple of days, it will be detailed in the UK that there are already phased plans. Germany in particular is in almost a second phase of winding down the lockdown. So that's where we are. I wanted to put this slide up here. Is obviously these forecasts are changing all the time, and this was a snapshot that we took a few weeks back. But I just wanted to put that up just to give you a scale of what was being thrown out there in terms of GDP contractions. Q2, as you can see, there's annualized contractions in the major economies of 20, 30, even 40%. These are gigantic numbers that we haven't seen certainly for almost 100 years, I think, in many economies. The full year outlook doesn't look quite as bad when you take the global picture. I think the IMF has subsequently, as we'll see later, has come in with a forecast for a 3% contraction for full year 2020. But so many variations of forecasts, as you can see from this, huge variations. This is largely finger in the wind. The governments are shutting down economies or have shut them down. It's very hard to see how exactly they will be restarted and how much time that will take. And so the variation of forecasters of where we are is the big question. What's the recovery going to be like? How quickly? Put it in a historical context. I mean, many people have their own measures of it. Deutsche Bank, I thought, was the most interesting. They go back several hundred years to try and get a scale of what's really happening here. And they're looking at full year contractions of 10% or more have only happened in the 1930s depression or through other pandemics through hundreds of years in the Middle Ages, the Black Death and so on. This is the scale of where we are for the United States. If their forecast of 4.2% of a contraction for the full year is true, that would put it, as the 18th worst contraction in 230 years of U.S. history. The Depression being the obvious one, and shortly after the war were worse. For Britain, I think you'll have seen the Bank of England this morning talk about probably one of its scenarios being one of the worst recessions in the UK in over 300 years. At the moment, consensus is not quite their level, but it would put it as the third worst roughly in 100 years. So that's the historical context. We're already seeing the data come through. You can see Spain, France, Italy. The GDP Q1 numbers that we saw in the last couple of weeks were actually worse than many people expected. And that's before we get to what most people feel will be the depth of this contraction, which is the quarter that we're currently in. But already we're seeing historically huge drawdowns. And I think in the United States, there are many ways to view the hit to the economy there, but the most dramatic is the employment situation. And you can see yesterday, this is the private sector payrolls, 20 million drop in payrolls in just 1 month in April. You can see historically over the last 20 years, this has never been seen before. The IMF, as I said, has put its mark on where things will be at. And as you can see from here, this is a quarterly. It distinguishes between developed and emerging economies. It sees about a 3% contraction for the full year. But again, you're starting to look at shapes of recovery and how that would be. And of course, this gets us into the alphabet soup of what the recovery shape will be, something the markets are obviously still obsessing about. From looking at this, you might see a bit of a V, but I think what you can also see is what I think consensus is developing around, which is this tick-shaped recovery, which is this sharp drop down and then a gradual climb back, which will take a lot longer. And I think increasingly that's what people imagine it to be. But we've never seen something like this. So the shapes are often very simplistic. What will offset the huge contractions related to the lockdowns is the scale of the policy response. It's been as dramatic, arguably, as the GDP drawdown. It was happened initially quite hesitantly, but when it arrived, certainly the central bank and the government spending stimulus were massive and unprecedented, and equally, if not more significant than what they brought to bear in 2009. Interest rates floored to zero, already trending there over many years, but very obviously. But clearly the big heavy lifting was done by central bank, expanding balance sheets, the Fed, the ECB, huge amounts of varieties of programs. And here we see dramatic increases in the bank balance sheets that will now, as you can see here, I've taken Morgan Stanley, I think, put a very good overview of where they think it is, and they put their own estimates in. And I think these graphics are very useful. It shows you the scale of this expansion relative to GDP. we're talking about 20 or 30% of GDP expansions expected over the next 2 years, and the G4 graphic tells you just what this is worldwide. Massive numbers. The Fed's balance sheet is already close to 7 trillion, and the ECB, even though it is a much smaller amount so far, is expected to expand its over the next 6 months as well. The Bank of England held back today, but again, I think most people would assume that its QE program will go up a gear in June. Here's our forecast from Reuters polls. This is consensus forecast of where the Fed will go, 10 plus trillion from where we are at the moment, so another 3 trillion or more over the next 18 months or so. The ECB, likewise, there's obviously a huge pressure on the ECB, given that the economic contraction in the forecasts, not least from the European Commission yesterday, are now putting the contraction, full-year contraction in the Eurozone at somewhere in the 7.8%, with contractions in Italy, Spain, talking about, and Greece talking about 9.7, 9.8, 9.5, in that territory. So the ECB, while arguing that more and more fiscal policy should be thrown at it, is clearly going to have to expand its balance sheet more as well. As you can see from estimates from PICTE here that I've put in a graphic that we've published already, they reckon the current plan, pandemic QE plan, the PEP, as it's known as, will exhausted itself at the current pace of bond buying by October. So at some point, that's going to need to be increased. And as you would all have seen this week, the German Constitutional Court's question mark over ECB bond buying and the Bundesbank's participation in it is an interesting question mark that's been thrown on it, which maybe we can speak about later. Clearly, the impact of the balance sheet expansion is on government bonds and government bond yields, moving very, very dramatically back to zero. The United States at record lows, and I think I think you can see from this graphic right at the end that the Italy and Spain, the spreads in Europe, have moved out, and I think this is a question over just how far the ECB can go in stabilizing all of the bond markets in Europe, and to what extent issues like neutralization of the debt and the wider Eurozone and EU recovery plan, how that comes together and how quickly it can be brought together. Some questions clearly raised, and you can see it within those spreads. Public debt is already extremely high and had been rising before, as we can now probably assume that the budget deficits and debt to GDP ratios will blow out even further as a result of the amount of spending being brought to bear to stabilize the situation. Spending largely as income replacement for companies and households who have been forced to shut down, rather than spending to stimulate, and this is significant, and it gets us right to the heart of what the legacy of this will be. I think again going back to the Commission forecasts, Eurozone debt to GDP will be above 100% completely, but you can see forecasts for Italy at 160% or almost, and even in the United States moving above 100% of debt to GDP levels. These are all questions and flags. So going back to the shape of the recovery, here's a Reuters poll conducted a few weeks back just on what forecasters expect the shape of it to be. You can see all the alphabet there. The consensus seems to be on a U, which would be the sharp drawdown we've seen, a very low activity for a quarter or two, and then a very sharp bounce back as we get into 2021. But I think the tick, as we can see, is becoming more likely, because I think the idea that there economies would be switched back on instantly, or indeed that consumers and businesses would be able to resume instantly and would want to resume instantly is a major question, and that the recovery could be a slower recovery. Of course, there are those who think that a double dip is possible, certainly within the markets. I think two particular funds, Jeffrey Gundlach at Double Line in the States and Elliott, the hedge fund, are on the record over the last month as saying that a double dip in the stock market is their best guess, and they see a relapse to breach the March lows as possible. So W is definitely in some people's minds, but obviously there's a whole variety of views, and some of the biggest asset managers, I think, would be favoring certainly U or a tick. I think V is maybe too optimistic. The numbers, as we're seeing them, as dramatic as they are undershooting forecasts, and I think that is also a worry as we take stock of the market recovery. Is that this is not as bad as consensus is, as deep as consensus is. This is also beginning to surprise on the downside already. Economic data has lagged, of course. And markets are looking ahead, but the surprising indicators here are still showing that it's even worse than we thought. So going back to the markets, the graphic here that we saw just gives us a picture of the global stock market. We can see the volatility levels with the VIX. Interesting, the VIX didn't, on an intraday basis at least, didn't top 2008. Got very close, but didn't top it. And has come back and stubbornly sitting above 30% at the moment. So still implied volatility extremely high in the marketplace, but we've seen a dramatic bounce back. Here's the kind of numbers of where we are. We had one of the sharpest drawdowns, I think it's in 22 days or so, of the 34% drop in world stocks, but we're back about 25%, net down about 17%. So you can see that the market's regained about half the points peak to trough loss and is starting to flatten out here while we absorb new information. So we're about halfway back to where we were, about almost 20% down net from where we were in February 20th. That tallies a lot, actually, with some of the forecasts for where people are seeing future earnings at. I know JP Morgan, for one, feels that earnings are going to be 20% or so, global earnings are going to be 20% below where they would have been otherwise at the end of 2021 as a result of this. And that kind of gives you a picture of maybe the lasting impact on markets so far. Stress within the markets was extreme, but I think some of that has dissipated quite considerably. And here's a graphic just to try and capture all of that. We saw the VIX, as we said, implied volatility in foreign exchange, in equities. Also, the huge amounts of scramble for dollars around the world was a very particular part of the crisis. Obviously, companies with cash flow freezes, desperate to raise dollar cash, not least in emerging markets and elsewhere. But you could see that reflected in the FX currency, the basis swaps, and these have been considerably addressed by the central banks, who have, particularly the Fed, which has opened up its swap operations around the world and on a more frequent daily basis now. So they have been pretty successful in both reducing that stress in the FX swaps market, but also in dollar LIBOR, OIS spreads, as you can see, which have, I think, more than halved from the peak of the crisis. So there's been some success in stabilizing the initial stress within the money markets. Here an additional problem was oil, demand problems and oversupply in oil. So as we all saw a couple of weeks back, saw a huge collapse in US crude in particular into negative territory never seen before. Whole issues around storage. Some of that is recovering. I know Brent is back above 30. But again, oil very important in the credit markets, in the sense that so much of the junk bond market in the United States is from shale oil. And so this was one of the transmission mechanisms that people felt was unhelpful, although you'd imagine once economies start, certainly cheaper oil will help. The other aspects of the credit market, which again was where people were most worried about, have healed considerably. Here's the ETFs in the investment grade corporate bonds. You can see it's almost a perfect V. Again, activity from the Fed, the ECB, elsewhere, hugely important in stabilizing those. The junk bond market also recovered, although less so. But again, the Fed is buying junk bonds as part of its program for the first time. The ECB is accepting sub-investment grade collateral and is expected to, at some point over the coming months, possibly do the same as the Fed in terms of outright buying of investment grade or sub-investment grade bonds as well. FX, there's a whole story around just the dollar itself and the scramble for dollar funding. That was a huge part of it. This is a huge battleground, as many of you in the FX markets will already know. Here's just a picture of the main exchange rates. Dollar still considerably stronger against most currencies. Although interestingly, from the beginning of the year, that euro dollar is broadly stable and holding up. The issue in the FX market is clearly one around whether the Fed's relative money printing, if you like, its QE campaign, which is running at the moment, I think, at almost twice the ECB level. Is something that ultimately will reduce that stress from dollars and ultimately see the dollar weaken over time. The alternative view is that this will create, there will be stress and dollar demand that will persist for a lot longer and will offset this, and ultimately other central banks will come and do as much easing as the Fed eventually, as their economies suffer more greatly. That's a battleground that is up for debate. But as you can see from positioning here in the speculative market, the bias is still towards a weaker dollar over time. So the speculative market, at least, still thinks the dollar will ultimately weaken. That may tally with President Trump's wishes too. Here we just look at impact on the LIBOR market and the money markets. We've seen kind of dollar LIBOR OIS spreads blow out quite a bit and recover, but also Euribor, as you well know, clearly quite recently coming under some significant stress relative to elsewhere. In part, this is due to concerns about banks, in particularly in the periphery and Southern Europe, and whether there is differential access to funds and related stress due to downgrades, non-performing loans, and other areas that will create stress. So Euribor is important to watch as well. Emerging markets have been particularly badly hit. These are dramatic outflows that we've seen. This is a daily tracker from the IIF. It shows you the scale of what was happening. If you take it excluding China, which is already recovering, it's been gigantic, and certainly EMFX and EM equities, as you can see here, taking an outsized hit. This is related not only to the access to dollars, where there's a lot of heavy dollar debts out there, but also the implication of a hit to globalization going forward, to supply chains, and to global trade that will ultimately hit it, and the oil price for many emerging economies that are exposed to energy. So where we are with equity outlook, I think many people think that the forward equity market isn't fully taking a view of how serious this will be. These estimates for different countries compare against the forward EPS assumptions based in the previous crisis in 2008, 2009, and also the dot-com crisis. You can see so far those downward revisions aren't as much. That may well be the scale of the support. That may well be that people think this will be a much shorter episode than the previous. But you can see many people feeling that there is still some way to go in estimating the hit to earnings. This explains some of what's happened. There was an indiscriminate sell-off in the equity market to begin with, but the return or the bounce back has been much more discriminating, and clearly tech has been the big winner. And if you can see here from this graphic, as a proportion of the overall world stocks, tech and pharma, which is the other big winner clearly for obvious reasons, are likely to be more than 40% of world market cap, while banks and energy are the losers. You can see even the top 5 US FANGs, the main technology stocks, increasing their share of overall world market cap. Clearly, from the earnings we saw recently from the likes of Netflix and from Amazon and everything else, you can see just why that might be the case. View of the future, here's surveys that give us some picture of how long it takes people, the general public thinks it will take to get back to normal. Just as an illustration of that, here's a UK survey that tells us that even when the lockdown ends, and that in the UK at least, and in many countries may not be until July, fully at least until July or August, when large gatherings are allowed, that people will still be reluctant, some 40% of people still reluctant to go to gyms or use healthcare, use various pubs and bars, restaurants, travel. And so the lingering effects of this will be an issue. Inflation, which is a big question longer term, it doesn't appear to be a problem if you look at, certainly not for now. Deflation is maybe a bigger worry. But longer term, there are a number of questions that we are left with. How long is this going to affect consumers even after we end the lockdown? So markets have been working off timing of the restrictions ending, but ultimately there will be effects that go well beyond that. That's a big question. How does it hit globalization, trade, supply chains? That will be huge. What's the legacy on finances, and are they sustainable over time? Will central bank and governments increasingly cooperate? Could we see monetary financing, and et cetera, et cetera? Inflation, as we just mentioned, this is a big question over time if central banks continue these policies for much longer. And then what is the impact on politics and society? And with that, I think we'll move to the most obvious and immediate impact on politics, which is the US election later this year, and what the impact will be on President Trump's chances of re-election. And I hand you over to my colleague, Dan Burns, for his take on that, and maybe answer questions later. Thank you.
Good afternoon. I did want to briefly, before turning to that question, return to one of Mike's slides on what's happening with that. I know this is a foreign exchange, a currency trading audience, and I think one of the questions everybody has is what's happening with the dollar strength relative to the massive quantitative easing undertaken right now by the Federal Reserve. And you can see there I wanted to touch back to the public sector debt. One of the bigger stories this week potentially that was maybe not played up as much is what stands before us as the absolute mountain of debt that is going to be rolling out of the U.S. Treasury in just the next 3 months. And that perhaps explains a little bit of the dynamic that's been affecting the dollar in the last couple of months. The Fed obviously is buying an enormous amount of assets, but its pace of purchases has slowed dramatically in the last couple of weeks from that initial hectic pace when it was buying north of $600 billion of assets in the space of a week. It's now down to a little less than $100 billion each week. But what's happening with the issuance of treasuries, which is going to be $3 trillion in this quarter alone? By context, that exceeds the record annual net issuance of treasuries by about 1.2 trillion. The highest was 1.8 trillion back in the financial crisis for an entire year. So in the space of 3 months, you're going to see $3 trillion of treasury issuance, largely in bills. Now, there's a funny dynamic that happens to impede the dollar weakening here, because initially, a lot of that money gets deposited by the Treasury directly at the Fed in the Treasury General Account, which has been exploding in size. To explain a little bit of the dynamic, and some of you may know it, but When the Fed is in quantitative easing, it is creating money, and it is expanding bank reserves by buying bonds directly from the banks. That expands their reserves. But then the Treasury now is ramping up issuance, and those reserves are then being mopped up. The reserve expansion ought to be a dollar weakening event, but now these reserves are eventually being mopped up as these primary dealers then go out and buy the treasuries being issued by the U.S. Treasury. And that slide that you're looking at there that shows the U.S. at roughly 100% of GDP in total debt, we are clearly going to exceed that in the very, very near term. Two dynamics there, obviously, and we'll get to my main presentation on that front now, is that GDP in the United States is going to be contracting from a nominal level of about 21 trillion coming into the event to potentially as low on an annualized rate of 18, maybe even less trillion by the time we get through this quarter. The question then becomes what type of recovery we have. I wanted to quickly come to what is the main dynamic here in the United States, obviously, and that is the virus's effect on employment. We've seen lots and lots of horrific employment figures around the world, but potentially nowhere quite as pronounced as they are in the United States. And here you see a little bit of a breakdown of yesterday's report from ADP, which is a payrolls processor, and they precede the monthly Labor Department job report, which is due out tomorrow, by a couple of days, and they strictly measure just the private sector. And you could see that we had 20.2 million jobs lost in the month of April alone. And you could see then in the right panel there that the total employment is now back. In the space of a month, we were taken from a record high level of employment now to the lowest level of employment since 2011. And when you see the division there between the service providing sector, which is clearly the largest part of the U.S. economy, and goods production, service providing jobs dropped by about 16 million, and goods producing jobs, which includes manufacturing, construction, et cetera, they dropped by about 4 million, now to a level below the lowest level in the series history going back to 2001 when ADP started this. So it's clearly been a very traumatic event in the United States from an employment point of view. You could see we're looking here at the size of where this falls on by firm size, and you can see that more than 20% of employees at companies with between 20 and 50 workers lost their jobs in April. That's about 6 percentage points higher than the average. And it shows you that while this has been an event that has left few corners of the United States economy unscarred, it has clearly been hardest felt by the smallest companies in the United States. You contrast that with companies that employ 1,000 workers or more, and you could see while they too cut more than 7 million jobs, it represented a far smaller share. And a lot of that dynamic obviously is represented in which jobs can be performed on site or from home. I'm continuing to work. Mike is continuing to work. We're coming to you from our houses in the UK and the US, respectively. A number of you as financial market professionals are continuing to work, but those people who have to go to work, unless they were deemed an essential worker, a grocery store clerk, an emergency room technician or nurse or physician, a first responder of any sort, those people were furloughed or were laid off. So this is, it's had an enormously uneven effect, and we will see a lot more of that detail when we get the Labor Department report tomorrow. We'll see greater detail by sector, by gender, by race. It's not been evenly distributed across any of those factors, and that will be laid quite tomorrow. And we see the contributions to U.S. GDP that we saw in the first quarter, and that is only, unfortunately, a very shallow precursor for what we will see for the second quarter, as Mike alluded to. Overall, a 4.8% drop, but you could see that orange bar there is the contribution to the fall from the massive drop in consumer spending. And what's remarkable about this number is that probably until about the 15th of March, the United States was on trajectory to have 2% growth in the first quarter. And because of the sudden realization, as Mike was saying, that the coronavirus was not going to be contained in China, and that there was already a very serious outbreak in the United States that had been unfolding literally under our nose for some time, that prompted these very sudden orders: stay at home, only essential workers may go to work. All of that ceasing of activity in the space of just 2 weeks resulted in an annualized contraction in the first quarter of 4.8%. So if you just took that 2-week window and annualized that, you would get to what we expect to see as somewhere between a 20% and 30% contraction in activity in the current quarter. The question on everybody's mind, as Mike said, is, of course, will it be a V, a W? Will it be a sine wave? Maybe it's not a W, maybe it's a sine wave, or as one of my editors likes to joke, a Loch Ness shaped recovery, where you see the humps of that creature in the Great Scottish Lake popping up above the waterline and back beneath it several times. Is anybody's guess. Now, that one of the conundrums, of course, imposing one of the questions everybody has is, with all of this massive effort to fight the virus and contain the damage, will it be ultimately a post-virus inflationary event? The data you're looking at here, which is the five-year forward break-even inflation rate, is one of the very favored measures by Fed policymakers for estimating how well anchored inflation expectations are, and whether there's risk, where the risk directionally for inflation lies. And you could see there that this is not a favorable outlook for those who contend that with all of this central bank money printing, that when we get to the other side of this event, that it will be inflationary, potentially hyperinflationary. On balance, I think this looks to be a long-term disinflation event. The bigger risk, of course, being that it's an outright deflationary event. But it's hard to see an episode where, coming out of this, there is enough overall final demand from consumers and businesses to spur any measure of hyperinflation. I believe there was at least potentially a Brookings Institution study recently that still by the end of this year in the United States, after having lost initially between 20 and 30 million jobs, there will still be a permanent loss of employment in the order of between 4 and 5 million which would still leave us with an unemployment rate in the high single digits for some time to come. That, of course, is not an inflation risk. This, of course, is another picture of what's happened with regard to the U.S. consumer. This is April's retail sales. Oh, actually, this is actually just the March retail sales that we got last month, just a couple of weeks ago. We'll see another read in about 10 days. In the space of 1 month, we nearly exceeded the entire loss of retail sales over 16 months in the Great Recession. So you could see that this has been an enormously disruptive event, and one that is going to play into the final risk, I think, of this year, which is the coming presidential election, for which the COVID-19 response from the Trump administration is going to be the center point of the campaign, both from his perspective as the incumbent seeking re-election, and of course his challenger, Democrat Joe Biden. You could see that while there was, this is the weekly Reuters Ipsos polling data that shows Trump's approval rating. I have a bit more data on the next slide that will be a little bit more current, but let's walk through this a bit. You can see that Trump has been, the approval ratings for Trump in the United States have been very consistent in that band around a little bit above or below 40%. He's never really gotten above 50% approval rating, which is really remarkable. I don't know that there's a president in modern history who hasn't had at least a brief time with an approval rating above 50%. But you could see that this also represents the stickiness with which he has a very loyal base that represents somewhere between 37 and 42% of the electorate, depending on how many people do turn out to vote this year. Looking at the final slide here, this is a little bit more recent, when we began to introduce questions about how Trump has handled the response to the outbreak. On balance, it continues to be very much reflective of the chart you saw just a moment ago. Roughly 38 to 40%, 42% do approve, and closer to 50% or above disapprove. Somewhere between 47 and 55% disapprove, which also reflects the same number that we have seen. You see a little bit of detail there about how he has been polling directly against Joe Biden. Biden has been, up to a couple of weeks ago, had been as many as 8 percentage points ahead in this polling. That gauge has narrowed in the last week to the point where it is down to within the credibility interval. Interestingly, that narrowing of the gap between Biden and Trump has not occurred with Trump's numbers rising. It's more been about Biden's numbers coming down. Joe Biden, of course, is trying to run a campaign from his home in Delaware. So it's a big challenge for a Democratic contender right now to get out before the people in an environment where we don't know in the United States, despite the beginnings of reopening efforts in a number of states. By, I think, the end of this week, we will be 30 states starting to try to reopen activity. And we won't know for a couple of weeks after that, maybe a month, whether that restarting of activity also rekindles growth in the virus, which makes not just the conducting of economic activity a potentially perilous event in the weeks ahead, than also conducting a campaign. So with that, I think we can kick it on back to our presenters for some Q&A.
Yes. Thank you, Dan. Thank you, Mike, for your time and for sharing your views today. Actually, we have some interesting questions showing up here. Maybe we can take a few minutes to reply to the audience. The first one I would say is maybe for Mike. How is the German Constitutional Court's decision this week on ECB bond purchases likely to affect ECB policy going forward?
Look, I think the decision was dramatic for many people. I certainly feel that the assumption was that this was already subject to the European Court of Justice, and therefore would be ruled likewise by the German court. But I think it raises some profound issues potentially for the ECB campaigns in years to come. Right now, I think its probably impact is pretty limited. It's referring to the PSPP, which was the QE campaign just prior to the pandemic. So it doesn't affect the pandemic rescue package, the 750 billion. And the PSPP was already being wound down considerably, as we could see from those graphics. And the Bundesbank, I think, participation in that was something like as low as 2%. So materially, even though it gives 3 months for a right of reply to the ECB, materially right now it shouldn't make a great deal of difference. And even if that were the case in 3 months' time, it's likely the ECB will prove the case, which they're being required to do, this case of proportionality, whether the campaign was proportional or not. But it does raise a key issue. The debt piles that Dan talked about and that I referred to, that we're going to be a legacy of this crisis. The question is, are they sustainable over time, or do they cause lasting damage? Is there something that needs to be done? Do we have to face another round of austerity, or are we able to manage debt to GDP ratios in excess of 100% across the developed world? The main answer to that is they are sustainable if the interest rate is sustainable and low enough. It's as simple as that, and that's where the central banks come in. There's no doubt that the Fed, and the Bank of England and the Bank of Japan are already in a mode that says they will do whatever it takes to keep bond yields down. And there's talk of yield curve control, all sorts of different issues, right out to MMT and everything else. However, what the German court has done is, longer term, it's raised a question about what extraordinary measures the ECB might subsequently do, and whether the German court and the European Court of Justice, who's the primary interpreter of the treaties by which govern the ECB. And these are questions that go to the fundamental aspect of the Eurozone. That there were questions that arose in the Euro crisis of 2011 and 2012. You'll be familiar with them in Spain, obviously. But these are real issues. So there are longer term issues that need to get worked out here. And I do think what it will end up doing is keeping a premium in European debt, particularly Southern European debt and the periphery in the Eurozone. A premium that you would hope that with debt mutualization and other big moves might close. And it certainly is a political signal from Germany, if not ostensibly, certainly implicitly, that other extraordinary ECB measures are being watched for so-called proportionality, and the German court will reserve the right to raise a red flag. So it is significant, not in the immediate, but in the longer term.
Thank you, Mike. Next question. Do you think that stock markets are discounting just one wave of the pandemic, or if it is already priced in a second wave at the end of 2020?
That's a really good question. It's the hardest question to answer, I guess. What exactly is being priced at the moment? As I said, I think early on in the presentation, what it looked like a V-shaped bounce seemed implausible, given how little long-term earnings projections and valuations had adjusted compared to previous crises. So I think what this bounce back has done is to reflect the scale of the support, and also is it a bit of a statistical dance as well? I mean, I think Goldman Sachs are quite interesting on this. If you look at this debate about the shape of the recovery, I mean, as Jan Hatzius, their US economist, says, if you look on a quarter-on-quarter basis for your GDP estimates, then almost certainly we'll get something like a V. If you look year on year, it won't look like a V at all. So stock markets are more prone to looking year on year, I think, and they have priced a considerable rebound in growth, but not a return for many quarters to the levels that we were previously. And the JP Morgan forecast for global earnings to be some 20% below previous projections at the end of 2021, I think is a reasonable estimate given where we stand. And the stock market is down, surprisingly, about 20%. So I think it's priced, if I was to guess at it, I think it's priced for that slow, swoosh, tick-like recovery that goes well into next year, rather than a sudden light switch and the V's that people had hoped for.
Thank you. Maybe the next one might be for Dan. Dan, tomorrow the US government will report record job losses for the US from coronavirus. What are you expecting?
Well, I talked a little bit about this in my presentation, but I think one of the more interesting and telling bits of data that will emerge tomorrow is one, the overall unemployment rate, which we're expecting to rise from just over 4% now to 16 or more percent. To put that in context, we plateaued at 10% in 2009 in the Great Financial Crisis. And the record post-war level high was about 10.8% in one of the recessions earlier in the 80s. So this is a genuinely frightening level of unemployment that we will see tomorrow. And the question is how long it sticks with us. And the other bit of information that's a little bit of causing a bit of dissonance is we have seen this progression on a week-to-week basis with these initial claims for unemployment benefits that have now, since the middle of March, exceeded 30 million. And we're getting another bit of data in about an hour with another 3 million expected to have filed in the most recent week, which would bring the running total to 33 million people who have lost work, at least temporarily, and are seeking state assistance in the interim. There's been some polling out that suggests that more than 3/4 of the people who have been laid off so far do expect to be recalled to the job that they had to walk away from in the last 6 weeks. So that is a figure that will, of course, not be reflected in tomorrow's numbers, but will be more evident in the weeks ahead and the months ahead. So we're watching very closely for this continuing flattening of the unemployment claims curve, and just how much further the net unemployment figure rises, and how that is distributed, particularly across the U.S. population by race, by gender, by age. We do suspect that women have borne an outsized proportion of the job losses because so many of women happen to be the dominant demographic in so many of the industries that were hardest hit. You think about the leisure and hospitality, the travel industry, where women frequently represented more than 40%, 50% or more of the workforce. So I think that will be something that we're going to be looking at quite closely when the numbers come tomorrow.
Thank you. Thank you, Adam. Another one, maybe for both of you, with regard to financing Eurozone debt, what you guys see it take place taking into consideration on what the German Constitutional Court came out? Will there be a personalized bailout for southern countries or Corona bonds as they ask for?
Again, a huge question. I think from the most recent European summit, the likelihood of the Corona bond is still very low. The resistance from Germany, Netherlands, Austria, and elsewhere is pretty extensive, and I think the German court decision certainly will embolden the German political position in resisting that, in the sense that clearly the German court is flexing its muscle in the sense of what action not only the ECB can take, but also in terms of the degree to which the existing treaties and existing rules of the Eurozone apply. Now, ultimately, the ECJ has the final decision on that, and should do. But I think it does come together, because it means that if there were a need for the sort of extraordinary policies that people are talking about right now, and certainly they're talking about it in the United States and Britain and elsewhere, that might mean greater cooperation and collaboration between both the central banks and the treasuries to stabilize this debt mountain going forward over the years ahead. Then it does create a problem there. And if there's no mutual single Eurobond, it's harder and harder for the ECB to imagine itself providing that sort of support, and certainly with those resistance. So for now, I don't see it. I think what we will see over the next few weeks is what the European Commission comes back with in terms of the recovery fund and how that will be constructed. And to some degree, that is a mutual effort in a direct fund. But the idea that we will get the beginnings of a single European or a single Eurozone instrument, I think that's got to be now some way off, and this week's events will have put it further back.
Okay. Thank you, Mike. Then, which would be the expected impact in the US dollar in case Joe Biden would win elections in the USA?
Oh, wow. Okay. Well, I don't know that we've polled specifically on that. I think a lot of it would hinge upon what we sense to be as Biden's ongoing fiscal response to what will certainly be, at a minimum, the tail effects of this crisis. So if Biden were to win, he would be taking office on January 20th, 2021, which would be roughly a year from the point at which this emerged on the global consciousness, and 10 months after it erupted into a full-blown crisis in the United States. So clearly, whoever, whether it's Trump beginning a second term or Biden launching his first term next January, both will be contending with that. I think it may not hinge so much on whether, on the assumption your question assumes Biden wins. I think the bigger question about how free he is to respond to the crisis aggressively will hinge upon how the election in the U.S. Senate plays out. As you know, right now, the House of Representatives is controlled by Democrats. There's very little expectation of change there. But Republicans have a very narrow majority in the U.S. Senate. And a greater number of vulnerable Republicans are up for re-election this time around. alongside at the same time that we'll be electing a president. So if Republicans continue and Mitch McConnell, the current Republican majority leader, continues to be the majority leader, Republicans continue to control the Senate, I think you would see difficulty from a Biden administration in having a very continuously aggressive fiscal response, a lot more spending, because it would not be within McConnell's interest, frankly, to be party to that. If, however, Democrats get the sweep, they win the White House, they have the House of Representatives, and they have the Senate, you could see pretty aggressive spending measures emerging from that outcome that may end up having a pretty pronounced effect, potentially weakening effect on the dollar.
Thank you for your reply. Then, Mike, also, I wish we could keep going with the questions. There are some remain unanswered, but I'm being told that we are running out of time. So, good news. On your screen, you must be seeing the email address of the presenters. So don't hesitate to reach out to them for any further questions. Also, those willing to activate an access to financial markets through Icon, my email is also visible. Use it, reach out to me, and provide, please, some feedback to Acer and ourselves so that we'll improve for the next webinars. Maybe we can prepare some questions before the start so that we leave nobody behind. It was so great to have you. Thank you again, Mike, Ben, Asset. It was a great time sharing everything with this financial professional audience here in Spain, and hope to see you soon. Have a great day, everyone.
Thank you.
Muchas gracias a todos por parte de Asset y nos vemos en la próxima webinar.
Absolutely. Thank you all, and